and welcome to another episode of Phillip Research in 3 minutes. This is Natalie from Phillip Securities Research, and in this episode, we will talk about our initiation report on Ascott Residence Trust. We initiated a buy on ART on the 9th of April at a target price of $1.36 when the last close was $1.18. Including distributions, our target price represents an upside of 21.5%. ART is an accommodation provider specializing in service residences, apart hotels, and business hotels. These accommodation types offer selected services and are targeted at corporate travelers who utilize them for longer durations ranging from 1 month to 2 years. ART's customers include MICE organizers and attendees, and expats on overseas project group assignments. Service residences are not new. They have been predominantly used by expats but have recently enjoyed a spike in popularity among leisure travelers owing to Airbnb, which has popularized the don't go there, live there experience. While thought to be cannibalistic for the hotel industry, it has done the opposite for service residences. Service residences provide comforting amenities found in a home, such as kitchenette, while sidestepping the safety concerns and inconsistent levels of quality that are common complaints for Airbnb guests. Moving on to the investment merits, we like ART on the grounds of income stability, which is achieved through 2 key pillars: geographical diversification and lease structure mix. 85% of income is sourced from 8 key markets, with no market contributing more than 15% of revenue. The proportion of EBIT sourced from developed versus developing markets is 75% to 25%, which provides an additional level of comfort. ART's revenue model is broken down into 3 lease types: the master lease and management contracts with minimum guaranteed income, guarantee fixed rent, which provides income visibility and account for 42% of gross profit. The management contracts, which are more variable in nature and dependent on the profitability of the accommodation, account for 58% of the income. We also favor ART for its strong balance sheet and rich parentage. ART has a gearing ratio of 34.2% and an asset base of $5.2 million. ART has a gearing ratio of 34.2% and an asset base of $5.4 billion. Assuming maximum gearing of 45%, ART will have a debt headroom of $880 million and the ability to pursue inorganic growth through asset acquisition. This is further sweetened by ART's low borrowing cost of 2.3% and ROFO pipeline of 20 assets. ART's sponsor, Ascott Limited, is the hospitality arm of real estate heavyweight CapitalN. The number of keys under Ascott Limited's management has been growing at a 3-year CAGR of 36.5% and currently stands at 100,000 keys. Ascott Limited intends to grow the number of keys under management to 160,000 by 2023. With most of ART's assets operated under the brands Ascott, Citadines, and Somerset, ART is poised to benefit from Ascott's growth trajectory as well as the brand and reputation that Ascott has built. ART is also expanding its income base through its expansion into a new co-living segment. Live One North is ART's maiden development project and first co-living asset, which is targeted at millennials who prefer a more social and experiential aspect. Finally, we like that service residences are less capital and operationally intensive. As customers tend to stay for longer durations, there is less wear and tear observed in comparison with hotels, which experience more frequent turnovers. With the limited selection of services offered in service residences, this translates into lower capex and opex requirements for service residences. For the full report, please visit our website, stocksbnb.com. Do like this video and give us your comments below.